Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. A lot of people wrote to me and said to me, Michael, should I be buying the dip on Roku? So this is just some of the thoughts I've been having, and I wanted to highlight to you why I'm avoiding this name for now, and I think that you should too. So even though the stock has taken a slight deceleration, the share price has sold off slightly, I think that paying 10 times forward sales for the platform business is actually not that cheap when all is considered. So just wanted to highlight a few things. So yeah, hopefully this will be helpful to you. So the investment sentiment turns quite negative, and 2 weeks ago I had written that having to pay 11 times forward sales doesn't leave new shareholders to the stock with a large margin of safety. It's best to avoid this name for now. And I also said that I believe that the market has underreacted to Roku's near-term prospects. 2 weeks later, and the stock has meaningfully sold off. So the underreaction that there was at first, well, you know, people are kind of finally woken up to what's actually at play here. One of the things that I wanted to highlight is that it's, you know, in 2020, Roku was like the crowd favorite. People were just like salivating Roku, and there was people just going crazy about it. So anyone that's kind of held a stock since 2020, going into 2021, they kind of think to themselves, okay, the stock is selling off, I'm going to book the gains, and that's just expediting the whole process here. People are just like dumping the stock. And I believe that, you know, it's not just sentiment, although sentiment in the short term plays a huge impact, obviously, but I think that the fundamentals are not as strong as they were, okay? So here are a few things, right? So first, you see that dramatic acceleration in growth rates coming out of 2020 into 2021. Then you see after the first half of 21, a dramatic deceleration in the revenue growth rates. So the guidance for Q4 is approximately 38%. You leave some space for kind of them being conservative, and you're kind of seeing a stock at 40% growth rates. Now you have to think to yourself, how sustainable is that 40% going into 2022, particularly against the first half? How is it going to comp the first half of 2021? Okay, that's one thing that I want to highlight. The other thing that I want to highlight is that they're just trying to think through, will the stock be able to grow sustainably at approximately the high 30s, or is it going to come down to let's say the low 30s, because it has a dramatic implication on the multiple that investors will be willing to pay for the stock. Okay, and just want to highlight a few things here. So this here is a graph that I've made kind of showing the platform versus the player. So the player is the hardware. That's really, they operate that at close to break even to get people onto the platform. Okay, so that's the entry point, as you will. An easy way to think about it is like the iPhone. So the iPhone brings people into the Apple ecosystem, and from that you're able to kind of leverage the services, etc., etc. But you need people to get onto the platform, and that you have to sell in the player, and that's why they try and sell it at close to break even. Now, in the past, it was kind of it was historically close to break even. But then for Q2 it was negative 6%, and Q3 was negative 15%. The gross margin the gross margins on the player. I estimate from management's comments that they say that global supply chains and disruptions will likely impact the overall holiday season in terms of shipping delays, product availability issues, and product prices increases. So all that taken together, I just said, okay, let's just estimate that from Q3 into Q4 is pretty much the same, negative 15% for the gross margins for the player. So that means that it's kind of like the revenues that you're paying on this side of the business are just worthless, okay? So what you're left with is trying to figure out, okay, they're selling this at a loss. Are they seeing a proportional increase in active accounts? And you can see here that from Q3 2020 into Q4 2020, there was a jump of 11% in active accounts, but there was a sequential jump. But from Q2 2021 into Q3, you see that this is a 2% increase from 55 million to 56 million. There's just a 2% increase in active accounts. So they're selling this thing at a loss, and they're not seeing a spike in active accounts. That impacts downstream the amount of eyeballs that they're going to have. That impacts the revenues that they're going to have. So altogether, I think it's quite difficult because it's not so much about the tangible hard numbers that they're going to get in Q4. It's much more about the trajectory, trying to understand the trajectory in active accounts, because that's going to drive advertisers to the platform. So if you have a lot of eyeballs, that drives advertising, that drives the amount of retention also that they're going to have on the platform, and that drives advertising dollars, and that drives the revenues, and that drives the EBITDA. And if you don't have the spike in active users, then you're going to kind of be like, advertisers will go elsewhere. That's really what's going to happen. So here, one of the things I want to highlight. So 85%, let me repeat. 15% of Roku's revenues, which is the hardware business, you can throw that out. So you're left with 85% of what you have. So let's just use analyst estimates for next year at 3.8 billion for the business as a whole. You throw out the 15%, which is hardware, you're left with 3.2 billion, okay? Of that 3.2 billion, that is what is the crown jewel, let's call it. Those are the high margin advertising revenues. That comes at around 65% for gross margins. So compared to Pinterest has approximately 80% gross margins, compared to Snap has 55% gross margins. So in the middle, kind of, is Roku. So if you look at that 3.2 billion and you say has kind of middle of the road gross margin profile, paying 10 times forward sales for that business isn't really the bargain basement. If you have some kind of uncertainty, if you're sure that the business is going to grow, like let's say Snap, people are pretty much sure that it's going to grow at above 35% into 40, perhaps over the next few years, it's kind of worthwhile paying 15 times forward sales. On the other side of the equation, you have something like Pinterest, which is priced at 9 times forward sales for roughly 30% revenue growth rates. So why to pay 10 times forward sales for Roku when you have that uncertainty? I mean, it doesn't make a lot of sense to me. So that's why I'm not getting involved here. That's why I'm not deploying my capital here. And I said previously in my article 2 weeks ago, don't look for ideas that have 50-50 chance of getting right, or even 60-40 chance of working out favorably. Look for things that are 70% likely of working out favorably. And as I made the case, paying 10 times forward sales for the advertising business of Roku doesn't really seem to me to reach that 70% chance of working out favorably, because you have the heavy comps to come up against in H1 2022. You have the uncertainty whether the active users are going to continue to spike up or not. There's a lot of question marks still left here. So that's why I'm avoiding this name. But if you want to find out what kind of stocks I'm buying right now, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor, help you think through investing, and you can check out what other people have said in my reviews. Thank you so much for listening. Bye.